This is an Uncovered Japan company research report on Maruzen Showa Unyu, ticker 9068. It is a Japanese integrated logistics company that connects port operations, warehouses, trucking, and rail for industrial customers. The question is whether that specialist network deserves more credit and the market gives it. The starting snapshot is unusual for listed logistics. Maruzen trades on about 11.2 times forward earnings and 1.03 times book value, while its operating margin is 10.4% and its equity ratio is 69.4%. Those figures frame the case: a financially conservative operator whose profitability looks stronger than a typical trucking name. Third-party logistics means a customer outsources much of its supply chain operation to one partner. Maruzen is asset-based. It operates the port equipment, warehouses, trucks, and logistics network rather than merely brokering capacity. That lets it link import customs, Yokohama port transport, storage, land transport, and final delivery. For specialist industrial cargo, replacing that integrated workflow can take years. The segment mix makes the business easy to read. Logistics accounts for 87% of sales and earns a 10.4% operating margin. That segment bundles trucking, port transport, warehousing, and rail. On-site mechanical handling adds embedded work inside customer facilities, while the small other segment includes software, insurance, and property. This is a focused logistics franchise, not a diversified conglomerate. The moat is not scale alone. Maruzen serves blue-chip industrial shippers whose relationships often span decades, and its top 100 customers account for roughly 70% of sales. It combines a scarce port-anchored network with specialist handling for areas such as chemicals, temperature-controlled cargo, and industrial materials. Those capabilities matter more to customers than the lowest headline freight rate. Over the 5 years to fiscal 2026, revenue grew at only 1.7% annually, from 136.8 billion yen to 148.6 billion yen. Operating profit, however, compounded at 6.9%, reaching 15.5 billion yen. The operating margin widened from 8.6 to 10.4% through higher value-added 3PL work, pricing discipline, and cost control. It is a quality of earnings story, more than a volume story. The report makes an important distinction between operating progress and reported net income. Fiscal 2026 net income jumped because Maruzen sold cross-shareholdings, while operating profit increased a more measured 5.6%. That does not undermine the business, but it does mean investors should anchor their analysis on operating and recurring profit rather than mistake a below-the-line gain for a permanent step-up. Maruzen's balance sheet is one of its clearest differentiators. The fiscal 2026 equity ratio was 69.4%, rising from 62.4% 5 years earlier, and the company is effectively net cash. That creates capacity for automation, selective acquisitions, dividends, and buybacks without relying on leverage. The trade-off is that surplus cash can depress return on equity unless management keeps allocating it productively. Capital returns reinforce the financial case. Maruzen has raised its dividend for 12 consecutive years and has codified a 35% average payout floor. It also repurchased roughly 6.4 billion yen of shares over the last 3 years. The combined return profile is self-funded by cash generation, though investors should still judge it alongside the company's need to fund growth and automation. The 9th midterm plan targets 176 billion yen of revenue by fiscal 2029, implying roughly 6% compound growth from the latest base. That is a material acceleration from the prior 5 years. The route is investment in the Malos logistics system, warehouse automation, specialist verticals such as semiconductors, batteries, and pharmaceuticals, plus selective M&A. Execution on DX and overseas expansion is the central watch item. The report's 3-year scenarios are the author's estimates, not forecasts or recommendations. They range from a roughly flat bear case to higher base and bull cases if growth and margins hold. The valuation support comes from near-book pricing and the balance sheet, but the discount has real causes: slow historic revenue growth, driver and fuel costs, a modest institutional profile, and execution risk in automation, overseas operations, and the growth plan. Maruzen Showa Unyu combines a scarce integrated logistics model, strong industrial relationships, improving margins, and a conservative balance sheet. Its market valuation is modest, but so is its historic top-line growth. The facts to follow are whether the midterm plan lifts revenue, whether automation raises productivity, and whether the company keeps defending its specialist margins. This is research for education, not investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.